From the morning reading, bull flags form on Friday as the buyers buy, creating balance with the sellers following Thursday's sell-off. Breadth strengthened compared to the prior session as advancers led 1537 to 1432 on the New York Stock Exchange and decliners led 1444 to 1392 on the Nasdaq. On the S&P 500 snapshot, another record high this week. On Friday, the S&P opened near its daily high and promptly dropped to its daily low within a couple hours of the opening. The index continued the rest of the day inching up, ending with a daily gain of merely 0.05%. Week over week, the index saw a gain of 0.67%. The U.S. Treasury puts the closing yield on the 10-year note at 2.49%, up from the previous Friday's close. In other news, investors were hungry for fresh blood. The IPO of Snap on Thursday was well received. The offer of more than $3 billion not only saw a nice bump at the open, but managed to bring in retail traders during the day and end higher than its opening price. There have been 3 other time periods in the past 20 years where an IPO of more than $1 billion gained at least 30% after rallying during the trading day, which were prior to the market peaks of 2000, 2007, and 2015. One momentum streak finally ended. A couple of weeks ago, we looked at the S&P futures streak of more than 30 days without a bad close. It lasted until Thursday, and when the handful of other instances of such momentum finally faded, the futures tended to struggle over the next 1 to 2 months. New highs collapsed. Despite a small loss in stocks over the past 2 days, the number of securities hitting a 52-week high on the New York Stock Exchange has declined by more than 80%. And let's see if there's anything else I want to go over with you. I think that'll take care of it. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:03 a.m. Mountain Time, and I'm recording this in preparation for the market day of March the 6th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, we had a bit of weakness, but nothing significant. The S&P futures were down about 7.5 points, or about 1/3%, as was the Russell futures. NASDAQ futures are down about 1/4%, and the Dow futures are down just under 1/4%. Crude oil is down also about 1/3%. Euro's up about 0.4%, as is the long bond. Gold is up about 2/3%. In overseas action, it looks like everybody's participating. China's up about 0.5%. Hong Kong's up just over scratch. Japan's down about 0.5%. So Asia is quite mixed. Germany and United Kingdom both down about 1/3%. And macroeconomic reports for today of note for the United States. You've got FOMC member Kashkari speaking. You have factory orders. And those both occur, well, the first one, factory orders, is during market hours. FOMC member speaking is after market hours. And that looks to be about it for today. Looking forward to tomorrow, we have trade balance. And that looks to be about it. So a pretty light start of the week for the macroeconomic reports. In terms of current volatility conditions, short-term VIX an 8.56, exceptionally low. Skew is elevated up over the 135 threshold, coming in at 136.10. IV percentiles are still extremely low, though a little bit more skewed perhaps than we have seen most of the time of late, with the S&P at a 9, the NASDAQ at a 1, But on the flip side, the Russell's at a 15 and the Dow is at a 21. Now, all those values are extremely low. but we're seeing a little bit more separation perhaps across the four indices than we have commonly seen of late. In terms of standard deviation size moves, there were none on a close-to-close basis on Friday. Let's go ahead and take a look at the charts. And at this point, you can see that we've had this big horizontal breakout, and then it's been pretty much flagging ever since then. Right now, all this is just considered to be a bull flag continuation, absorbing this big move up, and with an expectation that the next move, the next leg, would be a breakout of this flag pattern. And that would be true until we would come down and probably break below this area here. So anything above about 2350 is still with an expectation of a continuation pattern to the upside on the S&P. On the Dow, very much a similar pattern. You see the big upward move, sideways consolidation, breakout, and then a flag pattern forming since then. On the NASDAQ, of course, has been on quite a tear of late. It also had a breakout and has been coming back to the prior area of resistance ever since. Nothing's broken down. I don't see anything here to give us any expectation other than mild pullbacks and then another bull legs up at this time until proven otherwise. Now, the Russell has been a bit different. After its huge tear and the post-election period, as many of these smaller cap companies are expected to benefit dramatically from the reduction in regulation. And think about it, a small company doesn't have the capital, the manpower, all those kinds of things to be able to handle the significant regulation that built up in recent years. So when the expectation that that regulation was going to be lessened on the small cap parts of the business, this really took off. Now, after this huge move up, we had this extended sideways period, broke up above this area, but just kind of chattered there and then had several closes back in. Lots of noise here with standard deviation size move both to the up and downside just to end up back where we started. So right now this all looks to be kind of an exhaustion pattern at this point and a settling back into the prior range. So a move back up will certainly have less resistance than it did last time, in that you've kind of nullified this former area of resistance with all this activity. And yet at the same time, the bulls seem to be quite tepid in their ability to kind of really move this up another leg. So the Russell definitely has changed its character to a more neutral posture, as opposed to where you see the NASDAQ, the Dow, and the S&P in a more stronger, straight-out bullish postures. Now, it's neutral is a relative degree. It's still above the cloud. It's still doing well in terms of it's holding on to these gains. And after that big move, holding on to these gains is significant. At the same time, in terms of future possibilities, it seems to be more limited than some other parts of the market. So just kind of keep that in mind. In terms of other markets, we've got crude oil, been in a sideways pattern now for many weeks, and nothing seems to have changed that. And gold, of course, has been tracking in a very tight inverse correlation with the dollar. And you see gold seems to be pulling back of late. Well, take a look at the dollar. The dollar seems to be, moving up of late with some pullback action late in the week last week. And then let's see, long bonds. Long bonds seem to be looking like they want to break down after this very extensive sideways consolidation pattern of late. This seems to be setting up to take out the 147 handle and to make another move to the downside. So watch bonds. Hasn't done that yet. It's a big market. Lots of very sophisticated players in that market. But certainly the appearances are that the bias is to the downside in the long bonds. and that could easily break any time. And then finally, volatility. Volatility still extremely low, still below a 12. And all this is basically noise down here, but just keep in mind that you've got extremely low volatility. So significant up moves or down moves in the equity markets are not expected when you have volatility this low. Okay, let's go ahead and jump into the daily report. And our market trend intermediate term phase opinion is still market phase 4. This is bullish. It's an extension pattern expectation. The 3 market timing signals, the first one coming to us from IBD, confirmed uptrend. The second one coming from the GMI index, that's a 5 out of 6. That buy signal has been in place since 11:10. And the third one, stock charts decision point scoreboard, we still have the same patterns that we had the last time we published. Short to intermediate term, all universally bullish. In the long term, all but one signal holdout on the NASDAQ has been turned bullish as well in recent sessions. So overall consensus here is very strongly bullish, with just that one lone real holdout to that opinion. So we've just about got the perfect stack that we like to see. And when we get that, we have the expectation of a long-term trending bullish market, with, of course, the periodic market exhales. But this is about as strong as we can expect to see. In terms of position sizing opinions, as you would expect, both are at 100%. Intermediate term market postures, exceptionally strong bulls, further supported by a strong bull sentiment line. Really no change on this through last week. We had a couple days that were a little weak last week and certainly challenged this. The Russell is just above the 80 threshold. If this were to drop below 80, it would go to a weak bear. So that's really the only thing in terms of real note on this at this point. The trend continues to hold up, is very strong. Hedge warning status remains 0+, but that's about as close to getting to level 0 as can be expected. So this is by definition normal bull market with some elevated conditions. In terms of the strategy opinions, VIX is, we'll put an asterisk on this. It at times is just above 12, at times it's just below a 12, and which would be below the acceptable range to initiate new positions for option income strategies for novice traders. So bottom line is just be aware that the current volatility conditions are, somewhat borderline for initiating new positions and being able to get enough premium for those positions to justify the risk. In terms of covered calls and put selling, everything's fine here, other than with this current extension patterns, just kind of be a bit conservative. Make sure you're mixing things up with high beta, low beta, out of the money, in the money strikes. The extremely low volatility we just talked about gives you the expectation that legs up are going to be somewhat muted after the already significant move. We're now 4 months post-election on this rally, and this may, I think I heard one reference, it actually quantified this. This may be the largest post-election rally in terms of not just how far it's gone, but also how much it's held on to those gains thus far at this time period post-election. So even the Ronald Reagan rally didn't hold on to quite these significant gains at this period of time. So it's difficult to add a lot of new bullish delta this far in without seeing something of a pullback to kind of sop up some of that enthusiasm. In terms of areas of specific warning, most of this is related to low volatility and the expectation that at some point volatility will expand. No real changes from what we've been seeing here. The skew is a true warning area. It's up over 135. Some of this could be written off to that we've got, so much profit that's been available since the post-election period. People are starting to do some put protection just to protect those profits. So nothing untoward here or fearful by any means at this point. In terms of the trend area, everything also quite benign here. Intermarket risk aversion indicators also in pretty good shape. 4 with risk on, 1 with risk off. Starting to see a little bit of angle and separation here, so these are actually been somewhat strengthening in the most recent sessions. Sentiment, we still have intermediate term stocks sentiment at an 8 out of 10, a bit elevated, and you see the fear and greed index at a 74, just under the threshold for extreme greed. In terms of sector specific, Friday's performance was mostly risk on. Financials getting another bounce back. They were the leader for the day, followed by healthcare, information tech, and industrials in the positive side. Most of the others were minor down with minor weak breadth, but nothing terribly exciting. You see utilities, consumer staples, real estate, mostly the defensives down here at the bottom. And they had been doing very well earlier in the week last week, and it looks like they gave back some of that on Friday with that Friday weakness. In terms of market posture by the various time frames, you see telecom, energy, and retail are the most obvious areas of relative weakness compared to other sectors across all 3 time frames. In terms of percent change, you see this performance in the 1 month. Some of our best performers, financials, healthcare, technology, all up over 5% in the 1 month time frame. So that's risk on. And then if you follow through to see the 5-day, well, for the most part, those same groups were also the performers for the last week. So best performers 1 day, 5-day, and 1 month are pretty much these same top 3, and they're all in that risk on kind of category. So that's a pretty good sign for the bulls. So that should be enough with that. In terms of relative rotation graph, you see the ones that are coming on: IYR, real estate, utilities, home construction. Home construction's had some good news of late, and certainly there's been a number of performers coming to us out of that industry group. And then also we've been talking a little bit about healthcare, and sometimes it's biotech that leads healthcare, sometimes it's biotech that weighs it down. But the XBI has been improving of late, though it certainly has not been a straight road, and you see where it's been coming from. But it has been improving. It's not in the upper right-hand quadrant yet, but still take note of these industry groups: IYR, XLU, ITB, XBI. All 4 of those are of note. Also, FDN has also been another one that has been, a leader in the past, had tailed off and looks to be coming back. So all those 5 industry groups would certainly seem to be something of interest for future opportunities. Okay, that should be enough for today. Let's go ahead and wrap this thing up. I'm going to scroll through a few slides. If you see something of interest, just hit the pause button. Also note hyperlinks that'll take you to greater details as well. Whoop, that's about too fast there. Disclaimers, as always, hit the pause button if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back with our next market preview sometime soon. We're going to continue to do this on a schedule of a few times a week, or any time that there's something significant happening in the market, especially one that raises our hedge risk level. But in the meantime, manage your risk profile, and you should see those consistent returns that you are seeking. Good trading.